Imagine you've got $100,000 in your account, ready to be invested. It's not just money, it's your dreams, your future, and even your ticket to financial freedom. But here's the challenge. Should you go with a growth-focused ETF like Vanguard's VOO or a dividend-paying powerhouse like Schwab's SCHD? Both have the potential to make you a millionaire, but one of them can do it faster. Which one will it be? All right, let's break it down. If you want to make your money work for you, you're in the right place. In this video, we will compare VOO and SCHD across all the important metrics: past performance, current returns, dividends, and risk. We'll dive into the numbers, show you what each fund is made of, and help you understand which one is better suited for your goals. By the end, we'll even do a side-by-side projection to see how these two ETFs stack up over the long term. Spoiler alert, one of them could double the return of the other. Ready to see which one comes out on top? Let's dive in. First, let's do some background checks on these ETFs, starting with the VOO, the Vanguard S&P 500 ETF. It tracks the S&P 500 index, which is a market capitalization-weighted index that measures the performance of 500 large-cap U.S. companies. These include giants like Apple, Microsoft, Amazon, and Alphabet, the market movers. One of the most significant selling points of VOO is its incredibly low management fees. That means more of your money stays invested, compounding over time. Conversely, we've got SCHD, the Schwab U.S. Dividend Equity ETF. This ETF plays a different game. Instead of chasing high growth, it focuses on reliable income. SCHD invests in companies with a solid track record of paying generous dividends. These aren't just stocks. They're carefully selected for their financial health and dividend consistency. SCHD is the steady ship that keeps generating income, even when the markets get rough. So VOO is all about fast growth and capital gains, while SCHD leans into stability and consistent income. Next, we will test their past performance, current returns, and future projections. Let's see which one leads. Starting with VOO, over the past decade, it's delivered an impressive annualized return of approximately 13.71%. That's no surprise, given its strong alignment with the S&P 500, which includes America's top-performing companies. SCHD, on the other hand, isn't far behind. Over the same period, it has provided a solid annualized return of about 11.87%. While slightly lower, this performance comes with the added advantage of consistent dividends, a cornerstone for stability, especially during turbulent times. Speaking of market conditions, VOO tends to shine during bull markets thanks to its focus on high-growth companies. However, when the market takes a downturn, SCHD's emphasis on dividend-paying stocks often acts as a safety net, offering steady income even when stock prices are falling. And here's a surprise twist. Year-to-date, SCHD has outperformed VOO, delivering a 4.14% return compared to VOO's 2.31%. But past and current returns only tell part of the story. What about other critical factors like expenses, dividends, and risk? Stick around because this battle is far from over. Let's break it down further by looking at the structure of these ETFs. First up, VOO. This massive ETF holds around 503 companies and provides broad exposure to the U.S. market. Its top 10 stocks, including tech giants like Apple, 7.6%, Microsoft, 6.29%, Amazon, 4.12%, and Alphabet, 2.22%, account for about 37.32% of its total weight. That significantly relies on a handful of mega-cap companies that thrive in booming markets. SCHD plays the field a bit differently. It holds about 101 companies, all carefully selected for their dividend history and financial strength. Its top 10 stocks, including names like Cisco Systems, Home Depot, and BlackRock, account for about 40.79% of the total weighting. That's a tighter basket of stocks than VOO, but it benefits from focusing on companies prioritizing shareholder returns through dividends. Now let's move on to expenses, because every penny counts when you're investing for the long haul. VOO's expense ratio is an incredibly low 0.03%, meaning that for every $10,000 invested, you pay just $3 annually in fees. That's one of the lowest in the industry. SCHD isn't far behind, with an expense ratio of 0.06%. It is still highly competitive, but double VOO's rate. Then there's the dividend game, and this is where SCHD truly shines. VOO's current dividend yield is 1.91%, with a dividend growth rate of 7.42%. While this is respectable, SCHD takes it to the next level with a 3.45% dividend yield and a dividend growth rate of 11.39%, making it a clear winner for investors seeking passive income. But we're not finished yet. Savvy investors know that assessing risk and sector exposure is just as important. So, which ETF offers better protection during market volatility? Let's start with VOO, which contributes to a sector weighting of around 27% in technology alone. That means VOO performs exceptionally well during growth markets, but may suffer significant losses during tech slumps or economic downturns. On the other hand, SCHD's sector exposure is more balanced, with industrials, consumer staples, and healthcare each playing key roles. This diversification helps SCHD remain relatively stable during market corrections when growth stocks falter. A key difference here is volatility. Over the past 10 years, VOO has shown a higher standard deviation than SCHD, indicating it experiences more dramatic price swings. SCHD, by contrast, typically has lower drawdowns during market crashes, thanks to its defensive dividend-paying stocks. Before we dive into the final comparison, please subscribe if you haven't already so you can receive more insights like these. Now, let's get into the side-by-side comparison. What happens if you invested $100,000 in both of these ETFs and let them grow for the long term? Starting with VOO, based on its historical return of 13.71% annually, here's what the projection looks like. After 1 year, your $100,000 would grow by $13,710. After 10 years, you'd have around $361,398, almost tripling your initial investment. Fast forward to 20 years. That same $100,000 would balloon to $1,306,090. After 30 years, your $100,000 would reach a solid $4,720,193, with annual dividends of $25,316. If you reinvest your dividends, that's impressive growth, but let's see how SCHD compares. With a more modest return of 11.87% annually, after 1 year, your $100,000 investment would grow by $11,870. After 10 years, that would bring you to $306,998, more than tripling your initial investment. After 20 years, the portfolio value would climb to $942,481, and after 30 years, your $100,000 would skyrocket to $2,893,404, with an impressive $185,839 in annual dividends. Here's the standout difference. VOO grows faster in total portfolio value, $4.72 million versus $2.89 million. SCHD provides significantly more dividend income over time. SCHD's dividends, $1.42 million, are 5 times greater than VOO's, $276,000. By year 30, SCHD's annual dividend alone is around $185,000, compared to VOO's approximately $25,000. This confirms SCHD's advantage in passive income, while VOO excels in overall capital growth. So, which one will you choose for your portfolio? Let me know in the comments below. Now that you've seen how VOO and SCHD stack up, you're probably wondering, which ETFs are the best options for 2025? I've got a list of the top 5 ETFs to buy in 2025, and trust me, you won't want to miss these.